What's going on, everybody? Mando Trading here. Today we're going to go over how I formed a daily bias and furthermore how I can make actionable decisions off of that daily bias. So two that fit criteria really well today was SPY and Google. So we'll take a look at those. Multiple different time frames, of course, but before we get into it, please like, subscribe to my channel. Keep making these if the demand for them is there. So we'll start out today on the daily time frame, and we're looking at ES. The reason I chart on ES rather than SPY or SPX is because you will get additional levels on ES from the fact that it trades 23 hours a day, 5 days a week, rather than SPY and SPX, where you're going to see some pretty big gaps. You're not necessarily going to get those on ES, and you'll get more specific levels, and to me that's much more important for what I'm trying to do. So rather than trying to decipher a gap, I would much rather prefer to just trade off a specific level, of course. So going into this week and going into today specifically, I'm looking at the daily right now, and if you notice, Friday we closed inside a bullish imbalance, right? And this bullish imbalance, why would this one matter more than, say, for example, this one that is currently not on my chart? The reason being, just based off of my model and how I'm taking trades, I am setting a range. So for example, recent swing range, the swing range that took out this high and that high as well, but this high predominantly was this run right here. So from this price low until high. Now, the difficult part and a reason why I don't try and call absolute tops and bottoms, and I like to let price kind of dictate when the trade might actually be a good possibility, rather than just trying to jump the gun and get into something and trying to absolutely nail the top and the bottom, is because do I really know this is actually the top or the bottom at this exact moment? Maybe not, right? For example, I could have thought this was the top right here. And what happened? We did retrace a little bit, but we took out another high. So range was not set here. So while this trend is still bullish, I'm not going to be the one to try and come out with a long-term or longer-term time frame and bias and, try and, short something down towards, I don't know, what I would view as a bullish retracement, right? It seems like it's the end of the world because of the range that we've had has been so big. But no market structure has been shifted in my book. So until that occurs, I'm going to remain bullish. Now, then it gets into, where would the bounce be? Is it going to be in this imbalance here? Is it going to be in this imbalance here? To me, it's more of like a day-by-day type of situation where I want to see how price reacts when it gets into said level. I mean, NASDAQ is a very similar situation right now, and NASDAQ is actually retraced lower, closer to that 0.79 retracement level. But ES has, been relatively stronger and has had a better time kind of maintaining strength, where NASDAQ is kind of giving it up much easier. So, but entering today, obviously we don't have this green candle, but going into today, we had the bullish bias. And if, you don't believe me, you can check Twitter, see my newsletter, whatever you want to do. But I was bullish, and I'm not saying bullish for the highs just yet. I'm saying bullish for a discount retracement bounce. And we had this imbalance right here, which we closed exactly on it to the exact tick today. And we also had this imbalance here when this was a gap, and this gap was from that overnight move, which was Tuesday into Wednesday, and that occurred from 5 o'clock to 6 o'clock p.m. Eastern, which is when that 1 hour when futures is offline. So do you get gaps? Yes, you do. But the timing of them, it's not going to be as long of a time frame for them to generate. Like if we were to go to a SPY chart or something like that, you're going to see much more gaps, and that's just based on the times when price is actually live. And you could see very similar in that in this price run here. I have to move this up a little bit more. See, again, this is when you're trying to pick a top, right? Not necessarily the top, but discount still below 50%, and here's your retracement down into it. And from that point, Do I believe it's going to be the start of that next run to another high? It could be, but it also could get up into this imbalance and reject. So, again, we're early on in the week, before CPI and PPI later on in the week. I did have a bullish bias, so I went into that today, Monday, with that in the back of my mind. Now, check out my newsletter, Markets with Mando. I'll put the link in the bio. Go to a 30-minute chart here and just take a look at SPY. So, visually, and you might hear it a lot on Twitter or from other people who are talking about it. At a certain point when you're making these huge moves in one way or the other, the logical reaction would be, oh, there has to be some sort of retracement. And while that would have been the right assessment today, like, again, similarly to me with the bullish bias heading into the day, where would we run into some trouble? So I have my imbalances here mapped out. So our highest one would be right up in this area here. Our next would be here. So how I'm finding those would be wick, body candle, wick, and in between this candle here and this candle here, you have what would be considered a gap. They're called fair value gaps. I call them imbalances for the most part, just because it's a little, when I was learning about them, I would try and break it down in the most simplest of terms possible. I think it's the word imbalance is a lot easier to understand than, a fair value gap, which is a term coined by ICT. So, but anyways, these are some imbalances to the downside here. And as we get into a previously bullish imbalance, that's where we kind of found a bottom, and this dates back a while. Let's see, that imbalance dates back to July 12th, all the way back here. And if you want to zoom in, this is actually a gap. Boom, right here. There's your bullish imbalance, and look where we catch. Boom, caught it right there. And Monday morning we gap up, so overnight futures were strong. We did make a move higher, and as market opens, as 4 a.m. opens, market starts to drift heading into the open before catching a run higher. Now, would that same range situation that I like to use apply? Well, the range that I like to look to go long in on those retracements is the 0.62 to 0.79 fibs. I don't trade off of fibs, I just use them for the measurements, and as you can see, there's your move higher. So let's just get rid of that for a second, just to show, like, this is what I do even on a shorter term time frame, like a 5-minute. I'm still doing that same thing. When highs and lows are taken out, I'm throwing those on. That way I can map my range, look for entries into specific imbalances within that 0.62, 0.79. Now if you flip it and you go in the inverse, like I have right up here, right, from high to low, it's the same situation. I look for premium would be over that 50%, and discount would be below it, and I'm looking for those as entry points. So for example, here you have SPY retraced. Obviously we had that on, and you saw it got into that 0.62 range before lifting off, right? In the process, it creates a bullish imbalance, which was right here. So here's your candle here, body candle higher, and your second wick to create that, imbalance right there. As you can see on both sides of it, there's no wick, right? And in that area, as price retraces into it, retraces in, fills it completely, and takes off. And it still comes back down for it one more time, bounce again, and we start to trickle higher. On the flip side of this, this would be viewed as a resistance level. The reason why, again, we made that market structure shift, right? We took out these lows here with this price run here. So I do have my fib set as if this is going to be, bearish, right? Now, this is a imbalance, a bearish imbalance in that. So why wouldn't I look to take this move short, right? Reason being, this is not quite up into 50%, and we do have a higher one. So to me, the best risk reward play would be to wait for the higher of the two that's still in my 0.62 to 0.79 range, right up in there. So ideally this would be a much better or less risky short than say this, right? If you wanted to play this and you took the short down here, one, you know, again, this is, you're not in, you know, a quote unquote discount for your puts yet. And you're also dealing with a pretty wide range. This is 448.47 all the way up to 450.94 or 62. That's a pretty big range that me personally, one, it didn't even have the backing. It wasn't above 50%, so it wasn't ideal for me anyways. But, you know, the range on that is really thick. So even in a situation like this, if I were to get, you know, say this big of an imbalance, even higher up in this vicinity where I want to short it, I could even crunch this thing down into a 15-minute, you know, 5-minute, whatever time frame to try and pinpoint a much, you know, smaller area or smaller imbalance to take that short from. So here's kind of a pretty interesting spot, and this is where we close out the day. Here's your 5-minute imbalance down, and again, we're in that 0.62 to 0.79 range. That's the range that I like to look for imbalances, and that is kind of where we close out today. And again, here's another boom. That would be a bullish imbalance right there, right? So you have candle, or wick, candle, wick, empty space in between here. That would be viewed as a support level moving forward. Now, when does this trade go wrong for me? You know, you could take it from two different perspectives, really. One, you know, again, if I'm looking at a 30-minute time frame, I'm expecting this trade to take a little more time to, you know, develop. Whereas if I was looking at this situation from a 5-minute chart, I'd probably be a little more tight with my stop and understand that, you know, I would want this move to happen rather quickly rather than take some time to develop. So you have one of two ways to kind of look at this. One being, okay, if you want your entry to be off of the start of this resistance or bearish imbalance right there, and your stop loss can be as simple as a close above here, that 451.42 level, right? That could be a way that you look at it. If you're looking for a longer time frame, and you see we still have another imbalance up here, just not, again, you know, this would be a pretty big risk for me to take as I'm entering at 450.75, and I'm a short-term trader, so I kind of have to get that out of the way. But some people don't trade short-dated contracts, so I'd understand. But, you know, to me, market structure would shift above this 452.89. Above that level, yeah, price could retrace back lower, but I would then look for one of these imbalances down here to catch and send this thing higher. We took out this high. That retracement, to me, you got one of two things that can happen. A, you can either take liquidity up high and look for liquidity down low, or shift market structure, retrace back into your discount of the range and look for an imbalance in there for the next leg higher. So there's still some information that is yet to be presented, but that's another reason why I don't really swing trade too much, especially not the indices. I swing trade, you know, stocks and commons, but options, I'm not a huge fan of it, just with the economic climate that we're in right now. But all right, I know I'm taking long, but we'll go over one more thing here. Google, and again, this is just another situation where the range, you know, you can use that to your advantage, and again, that's one of my favorite little setups that you can look for. So again, right off the bat, you can look, okay, this would be considered a swing high, right? Swing high, and price retraces lower, gets down in there. So on what price run was it that we took out that swing high? To me, and this is early in the morning too, you can say, okay, well, this price run here from low to high, that took out that price swing, right? So boom, boom. Okay, so is there a discount below 50% imbalance? Yes, indeed. There it is. You see it. You have your candle here, body candle higher, and your next candle here. What's in between? And this is what it's going to look like, where you don't have a wick coming up here, and you don't have a wick coming in this situation here. So the way that I look at it personally would be, as price gets down into this area here, I would expect a bounce higher, knowing my stop loss is just going to be below this swing low. Below that swing low, market structure shifts again to the downside, and the trade is done. But to me, that sets a nice little parameter for my trade. It sets the plan for itself, really. You know, I'm just letting price do its thing and let price dictate, you know, what my next action is going to be. Is every trade that you ever take going to work out? No. And if you think that, then you know, you might be in for a tough ride. But you know, that's not something that you know, I'm not looking for the 100% success rate. I'm looking for, you know, obviously a good one, but as long as I can manage my downside when trades don't go my way, I know that when the trades do go my way, I have very nice you know, risk reward on them, and you know, I can make up for a couple of those stop losses plus more. So that's really my overall idea. But as you can see, here we have our range set. Price retraces back down into discount, and it bounces again, this time forming another imbalance here. Price runs, continues to run higher, and you know, you have a couple here instances where price catch and run, and so on. I mean, you know, I can continue to chart these imbalances here. I will, just for the purpose of this, but and you could see that oftentimes price will retrace into them and take off. You know, at what point would you say, you know, oh, you know, why didn't this one work? Again, you could just always map out the range of the swing. So this high was taken out with what price run here? 50%, right? Boom, right off 50%. And if you look at it like this, look, we did have another imbalance here, and we had, you know, more up here. But again, why are these less likely to hold up than the one down here? Well, smart money, big money, they don't want to be paying a premium for their long. They would prefer to get them at a discount, and the discount of the range would be at below 50% of that range. So and again, you know, I'm not a Fibonacci trader, but you can use these as these extensions as kind of profit taking points and things like that, and that's kind of how I use them. Especially when I'm trading intraday, the way I look at it, I'll actually, for example, if we get this initial move and we start to run higher, I will then just automatically go to the next price run that took out the next swing high and move on from there and continue to let it, you know, play out in that sense. I mean, even this one, it would more rather be here, as, you know, I'm going from immediate short-term price swings in order to try and be as precise as possible. As you can see, 0.79 here. So what was the range, or what was the swing that took out that high right here? I can look at it from this, from that low here up to, where is it? Boom, that high here. Did we end up getting back down there? Oh, shocker. Boom, right up to 50%, and there's your next run up. So so that's a little bit of how I'm forming a daily bias, and how I use how I'm using fibs to map my range, and how I'm looking for imbalances to be presented in discount areas for me to take my entries. Does price run away sometimes and get away from me? Yes, absolutely. But again, to me, more important than anything else is to make sure that you know, the risk reward is always adding up. And you know, if you're buying a rip to the upside, you know, you're kind of leaving yourself open to the potential of a bullish retracement, a healthy retracement, wiping you out of your position. So to me, I would much rather just wait, let it come to me, and that way I'm really in control of my risk reward. So you know, again, if you like this video, I can do more like this. If you have any you know, recommendations or, you know, requests, just drop a comment, I'll make it. But for now, that's all I got. I'm gonna be doing some more live recaps and live trades you know, throughout the rest of this week. So when I post them, make sure you got you know, those bells on so you're alerted to it. And that's all I got. So till next time, I'll see you. Good luck, and we'll talk soon.